Hello, everyone. Good afternoon, and thank you for joining our webinar on planning for an acquisition. My name is Zachary Meisner, and I am the investment manager at Launch New York. Today's topic is critically important that founders should start thinking about today if you haven't already. Acquisitions don't happen by accident, and the companies that achieve the best outcomes are typically the ones that plan early, before a buyer shows up. Early planning creates leverage and allows founders to drive the process on their terms rather than reacting to it. For those of you who may not be familiar with us, Launch New York is a nonprofit organization focused on supporting high growth startups across New York, really working to build the innovation and build up local economies. We serve 36 counties in New York State, spanning from Buffalo to Albany, helping with high growth founders and supplying access to the tools and the support that they need to scale. Since our launch, we've supported over 1,900 startups through mentorship, creating nearly 10,000 jobs, and have made direct investments into 115 companies. Launch New York provides pro bono mentorship through our EIRs, who work closely with startups, several of whom are on this call with us today. And we provide access to the most active seed fund in New York State. Additionally, we have specialty programs designed to help with a wide range of founders with targeted support for under-resourced founders through our Founders Go Big program and founders developing clean energy solutions in our Eco Incubator. We recently launched our technical assistance program in October, which provides startups with pro bono access to legal, finance, and accounting services. For more information, please visit launchny.org. And now on to our speaker. Jason Klein has over 30 years of experience in financial services. He serves as the Senior VP of Wealth Management at UBS, where he is focused on managing client relationships, steering business development efforts, exit scenario planning, and team leadership. Jason is also currently the chairman for Secrets of Champions Advisory Board and formerly founder and co-owner of the Buffalo Wings, a pro roller hockey organization. And with that, I'll turn it over to Jason.
Thank you, Zach. It's an honor to be here. Frankly, wish that this organization, Zach and Marnie and Sydney and the whole team. I wish they were there when I owned a business here in the Western New York community, the Buffalo Wings, back in the late '90s. If you were one of the couple of hundred people who populated the 20,000 seat arena that we tried to play in that first year, thank you. But in all seriousness, part of why I do what I do is because I kind of felt like I exited poorly. The league still exists today. It's a not for profit and so on. It's just an amateur league for people to play in, but the pro team, the pro stuff is gone. That being said, it's part of why we work with business owners primarily on our team here at UBS. So that being said, great to see familiar faces here, a bunch of them. Full disclosure, I'm an LP shareholder, LP funds 1 and 2 for Launch New York. So love what Launch is about. Thank you to all the founders and the investors and entrepreneurs and residents and mentors and everyone in the ecosystem who are on the call here. It's a privilege to be here. What we're going to talk about today is, as the slide says, from startup to exit, wealth building for founders. We're going to get into what we believe is important for founders to be thinking about well in advance of an exit, years in advance. And I recognize as I look at the list of attendees on the webinar here that we've got companies on the call and in the portfolio who are in various stages of their maturity, if you will. So I'll just say that it's never too early to be thinking about these concepts and we'll walk through that. And just I guess a couple of other additional background items. As Zach mentioned, background on me. I have the luxury of captaining a 6-person team based here in the Buffalo UBS office. I've got one of my team partners, Elena Masuro, on the call. Elena, if you would just want to introduce yourself, give a bit of background on you for a minute, that'd be great.
Yes, thank you, Jason. Hi, everybody. My name is Elena Macero, and I am the team administrator on Jason's team, as well as a certified financial planner. I've been at UBS for close to 5 years now, and prior to joining Jason's team, I worked in our UBS Chief of Staff office for Wealth Management Americas in New York City, and a Buffalo native, so moved back, about a year ago now, and have been on Jason's team ever since. Looking forward to talking with you all today.
Thank you, Elena. Well, we'll jump to the presentation, then we'll probably take 20 to 25 minutes to walk through the presentation. We'll reference a few items and take questions afterwards. That first slide, someone must have found a picture of me jumping off a cliff in my first year of college. That's about how muscular I was playing college hockey, which explains why I'm a wealth advisor today. But anyway, not funny. So we'll run through these slides, and we're more than happy, by the way, to provide this deck as a follow up. Zach, I think you guys have it as well. So we'll send this out with some other materials that we'll reference throughout the call, throughout the webinar here. So look. Every founder needs an exit plan, right? And you might hear this again. You might think that this is something that you can deal with when you get offers down the road. Our strong advice is to develop an exit plan now, regardless of that stage at which you might be for your company. We talk about building wealth intentionally, designing your company with that dream exit in mind, right? What is it? Is it an IPO? Is it selling to private equity? Is it a financial buyer, a strategic buyer, et cetera? And constantly think about that, and that'll evolve. And I know you've got amazing mentors and entrepreneurs and residents who kind of help you walk through these things. It's intentional. Dilution, bad terms can erode ownership. We've seen this 100 times. I will tell you as we have, I think we have four business owner clients who are currently in they're selling their businesses. They're in term sheet phase. At least one of those was really regretting some of the money they brought in historically that they probably could have avoided. The diluted ownership. Still worked out. Don't get us wrong. Look, they're clients of ours. If they're clients of ours, they're inherently successful. They've inherently made money, right? So it's not the end of the world. But it could have been better, right? So we're going to talk more about the terms and ownership. The wealth gap. All this means here is that this we want to solve for how much money you might need in your life after you sell this business that you currently have. I say currently because I know there are several serial entrepreneurs on this call. I've met some of you, and you'll do it again after you succeed with this current business. So the exits are where the founders, and especially women, and especially diverse individuals, and we've got a bunch of them on the call here. I've had the luxury of meeting several of you, incredible businesses that you've got going, and frankly, you can create some generational wealth. So we want to kind of think about what that wealth, what that means for you, and we'll come back to a framework to keep in mind, as you frankly build your company. There's a book called Exit Right that we love. You can go back one slide, Elena, please. The Founder's Lens. All we're saying here is that if you've raised money, you're for sale. Right. Like there's a number, there's a price, there's a partner. This book, Exit Right, is fantastic. We've read a lot of books on exit planning and business transition planning. This is the best one I've ever read. If anyone wants a copy of that book, or reach out to us post call, and we'll get you a copy. Yeah, Lena, let's go to the next slide, please. So this is this is sort of a spectrum of exit strategies, right? It's not just at the end. If you look on the far right there, that post-sale transition, right? Like, well, that's not just where you start to think about exits, right? It's in the startup phase as well, and you could see the dots right along the line here. Family and friends funding, right? That's the startup phase. A bunch of you with your companies, I know that that's where you first get the money, right? It's your own money, it's family and friends money. You've got an idea, you've got this incredible opportunity to build that out with launch, and then what, right? Well, then you start to generate some growth, and you might be approached by venture capital, or you might want to approach venture capital. We see corporate debt financing, I think I understand that. Well, I've been on a couple of the presentations. You've had presentations from debt providers, whether they're SBA lenders, your commercial banks, et cetera. But that's all we mean by corporate debt financing, right? Sometimes it's talk about avoiding dilution. Sometimes it makes sense to bring in debt instead of diluting that equity. We'll come back to that. Gaining scale is this third column. What does that mean? Well, it's strategic mergers and acquisitions, partnerships. Maybe there's an initial public offering down the road, but that's where you can start to really scale, right? We all know the Buffalo unicorn story with ACV, right? They went public, they're still building out the company, and that can happen, right? You see it, it's here. Strong capital foundation, this fourth column. Think bond financing there, maybe some secondary offerings, secondary placements. Our firm UBS is, I think we have about $7 trillion under management, largest wealth manager in the known universe by asset level, I think, at this point. But we do secondaries for clients, right? If you have a $50 million net worth and you want to make an investment of a minimum of $1 million, you can invest in some companies here that are private. Sometimes there's a secondary offering of a company that's already public, and lots of firms do that. UBS does it, other firms do it, and we have a lot of wealthy and super wealthy clients who want to partake in those secondary placements. It's another way to bring capital in. And then that fifth column, fine tuning of operations. You can do bolt-on acquisitions there, right? What's a strategic acquisition that we could make that'll help the company out? And again, I know there are a couple of entrepreneurs and founders on the call here who I've had the privilege of speaking with, who are looking at some potential acquisitions, and then spinoffs. Hey, wait a minute, we realized we have this separate company, or we could create a separate company or a division of the company, spin it off as its own, bring capital in from that sale. So we see that often. Success finalization, the second to last column here, exit, like getting out entirely, if you will, or maybe it's internal succession. Who's going to take over the business? Is it the next generation, right? Is it your kids? Is it other executives? Is it an ESOP? Is it what does that succession look like? And there are all sorts of nuances to that we often talk with our business owner clients about, and you want to be sort of thinking about at that point. And again, post sale transition, where we started on this page, all right, what's next, right? What are you going to do once you sell the company? I will tell you the vast majority of the time, business owners regret the sale of their first company. They regret the terms, or they regret that they sold it too soon. That's the majority of the time. We attribute that to them likely not having been prepared enough. We see it often, and we work with our clients to try and understand that, hey, wait a minute, is it time yet? What are you going to do once that business is gone? We actually see, depression among entrepreneurs, right? Think about it, right? It's your life, it's your baby, it's your company, and all of a sudden it's not yours anymore, right? So it's important to define these things. What does life look like? Forget the adjusted EBITDA, right? You're like, oh, wait a minute, I've been taking all this money out of the company. That's how I'm paying for the car and the apartment wherever, and so on. And all of a sudden, yeah, you don't have the company paying for that anymore. Is that part of your lifestyle? We work with a bunch of pro athletes as well, and some entertainers, and I will tell you, it's a very similar conversation, right? What happens when your playing career is done and you're no longer making 5-10 million a year? Your lifestyle kind of needs to adjust, right? It's important to be thinking about these things. Elena, let's go to the next slide, please. So early on, right? What does this look like? You want to protect your stock, your vision, set it up, right? I know you spend a lot of time on this internally at launch. That cap table discipline to avoid the dilution is so important. We see this all the time where, oh no, there's it's a problem with the cap table. Forget that there are people on there you don't want on there anymore. That's a whole other conversation. But sometimes the cap tables can get messy. You want to keep some great records there. Keep that end in mind. Sorry, we left the D off there, but is it a strategic exit? Is it private equity? Is it an IPO? And again, that'll evolve. But keep thinking about those things as you go forward. Make sure that you've got the legal advisors, the structure, founder-friendly terms. Again, you've got incredible resources all around you at launch. Some people on the call, Jack, Al, et cetera, who can help you formulate that. And there are some really great corporate attorneys out there, who can assist as well. QSBS, we're going to come back to qualified small business stock and the 83B election. It's a fabulous way to make sure that you have more money, net money post sale, and start talking with those potential acquirers early, right? Meet them when you're at a conference, you're at an event. If the acquirers are in the room, potential acquirers, start talking with them. Ask them what their criteria is. Get to know them, because the relationship part of that is really important, right? And again, I know a couple of you have sold businesses before. The partner you bring in, right? That's that buyer. You're gonna work with them. You're likely going to have some sort of employment contract. Maybe it's 3 years with a 1-year option or something. But you want to be comfortable with these people. So anyway. That's that. Elena, next slide, please. So that growth stage is where you build the value, right? And you professionalize the company. Again, I chair the advisory board, as Zach said at the outset, for I'll call it a development stage company, called Secrets of Champions, and I'm just trying to get them to professionalize. I've begged them to work with launch, right? It's and it's finally happening, and it's great. But you got to do that. Your stakeholders, right? Share that timeline. Make sure they're aware of it. Valuation benchmarks. What are we worth now? What are the multiples out there for companies in my industry? I know there are some CPG companies on this call. Well, wait. What are the I don't know, maybe it's a food bar. What are the industry comps? Or it's, some music tech for schools, Sean. What are the comparables there, right? And therefore, okay, what do we need to do to hit those comps, to hit those benchmarks? So what's happening there is you're really de-risking the company for the buyers and yourself. What does that mean? Means a higher price later, right? A more optimal exit. So what do you do? 4 bullet points here: build governance, board audited financials. We can't repeat this one enough. Audited financials. When it comes time to exit, you've got to have audited financials. It's worth the cost of doing that. You'll get a multiple of the money that you spend on audited financials. You'll get that back. Super imperative. Have annual exit talks with your advisors, with your partners. This is not, it's not a one-time event, right? It really is a process. A number of you are probably being approached here and there from buyers. It might feel like it's out of the blue. It's still a process. Um, uh, Operations, customer base, revenue streams, strengthen all of that, right? That's, again, sorry for it's a marathon, not a sprint cliche, but it is a marathon, and you want to make sure you're constantly strengthening those things. Stock options to reward and retain key employees, right? You want to keep those good people, and that's a terrific way to do it, right? You buy into the company. It'll also, we'll come back to the 83B elections and the qualified small business stock in a few minutes here. Again, those stock options are really important, and we'll relate there. Secondaries, right? Selling off a piece of the company basically is what that means. You have to start building your own wealth. Next slide there, please, Elena. So later stage, prepping for an initial public offering or for sale. What are we trying to do here? Optimize valuations. Is it a strategic exit via acquisition, or is it an IPO? Make sure you've got a pre-sale planning strategy in place so that personally you're maximizing net proceeds. So what are some things you can do here to sort of accelerate value, if you will? Well, you can build brand visibility and credibility. Lots of ways to do that, right? Yes, that's marketing to a large degree. It's getting your name out there. Look, it's all sorts of different companies here, right? Some are only sort of B2B oriented, some are B2C oriented, right? So who do you market to, and where do you spend that time and energy? And figure that out, but build that visibility. It makes a really big difference. Again, we've got this luxury of perspective of buyers as well, right? We're constantly talking with PE firms and some venture capital funds and angels and whatnot. So brand visibility is really important. Engage those advisors. We've talked about this. Investment bankers. We've got a cadre of boutique investment banks who will spend time with you 2, 3, 4, even 5 years in advance of a potential exit. If they believe that, hey, there's something here, they'll talk with you, right? They want that business down the road. They're going to get paid when you sell, right? You sell for $100 million, and they're getting 5% of that. Like, they'll start working now, right? So just feel free to talk with us. As a follow up, reach out and say, hey, are there investment bankers who would talk with us right now to start having a conversation, even though it might be a few years in advance of a potential exit? Wealth managers, that's us. There are a lot of great wealth managers out there here in Western New York, not just at UBS, but But have these conversations. Your tax advisors, right? Your legal advisors, corporate attorneys. Spend some time with them. Maybe ask them when they're billing by the hour or the eighth of an hour to not bill you or be off the clock, but have these conversations, and we bring them in all the time with our clients, and have those serious discussions, those planning conversations. Know the proper timeline to maximize net proceeds, right? Look, well, wait a minute. We see a window here because of our industry that might close. We got to move fast. Or, all right, we got some time, right, over the next 2-3 years, but plot that out, if you will. Elena, next slide, please. So raising capital, what it can cost you. Again, I know at launch, you spent time on these. You can see the 3 columns here: type of capital, typical timing, and what those implications are. Friends and family, I'm guessing everyone on the call has been there on this one, right? It's kind of idea stage, right? It's kind of informal. Still, make sure those terms are clear, because when they're not, that's when the messes happen, the lawsuits happen down the road. Like, spend the time now to get that right, especially with your attorney. Angel investment, right? Pre-seed. You got Jack McGowan on the call here, who spends a lot of time there and is an expert on this front. These are typically kind of friendly terms. You're still going to get diluted down the road, but look, you need the capital, right? So venture capital, think Series A roughly. It's a bigger check size, but there's dilution, and yet they're probably going to ask for a board seat, so you end up having a little bit less control. So make sure you like that VC, right? There are some great ones, but there's also the reason why sometimes there's a different V word that's used instead of venture. But revenue-based financing, post-revenue, this is where you can loan, you can borrow, and it's a great way to not have as much dilution. Maybe you pay back the loan as a percentage of revenue. Is it an asset-based loan? Purchase order financing, something like that. But it'll impact your cash flow. So gotta weigh that out. Safe notes, convertible notes, and I know this is a focus area for launch companies, especially in those early rounds. It's pretty simple. It's quick. But when you convert, right, you could get diluted. So that's the balance, right? So anyway, I'm guessing most of you on the call are aware of everything on this table. Every dollar that you bring in changes your own ownership as the founder. All right. And it can change the timeline. It can change the flexibility that you have when you do exit. So know that cap table math, know those liquidation preferences. And sorry if it's Groundhog Day here, but align with investors. Make sure that you're comfortable with them. Make sure they share your vision, and manage timing, right? Be clear with them about what you think that timing is, and get their buy-in on that. What else can they bring besides the money, right? Is it introductions? Is it bringing we brought a couple of pro athletes to companies, even at the college level on the NIL front now, saying, hey, you know what, this guy's in your geography, bring him in, it'll help you with your branding and your marketing, things like that. It ended up being really valuable. So there's more than just the money that can be brought to the table here. Elena, next slide, please. So qualified small business stock. Elena, I'll ask you to address some of the items on here with Section 1202, and I'll lead with the conclusion as they tee you up. This is a way to realize greater net proceeds when you do exit. But Elena, go ahead on this one.
Yeah, thank you, Jason. I know you mentioned this earlier, but really just wanted to spend a few minutes here talking about qualified small business stock since it's such a powerful tool available for early stage companies. And it's really, most beneficial when it's planned for early. And the impact, as Jason mentioned, at exit can be really dramatic. So what is it for founders? It can allow you to sell your company and potentially pay little to no federal capital gains tax on a significant portion of your exit proceeds. And depending on when the stock was issued, the exclusion can be as high as, and you can see this in that chart on the slide here, 10 million per founder per company, or 15 million per founder per company, or 10 times your cost basis, whichever is greater. And why is it crucial to think about now and as early as you can is because the benefits really depend on several company level and shareholder level requirements, including, how the stock was acquired, the company's structure and asset size at issuance. It must be a U.S. C corporation, and how long the stock is held. And you can see in that founder's lens bucket on the side on the screen that there's a clear example and of the benefit that this can have, as well as the value of speaking about this with your tax and legal advisors, because there are many different ways to enhance and take the benefits here. Jason, anything you want to add?
Yeah, thank you, Lena. Just consult your team of advisors on advanced strategies. It says in the box here. Yeah, absolutely. Talk with your tax advisor before making decisions about whether to file. There can be exceptions, as as sort of obvious as this may seem. Every now and then, there's a reason to not do this, but most of the time, it makes sense. You've got to file within 30 days of acquisition of the acquisition, and you want to file when the fair market value of your stock is very low. That's the idea. So you end up, we see companies that have like no taxation on the exit or next to none because they fall into this area. We've got one right now that's going to close on April 30th. Like basically he's not going to owe any taxes when he sells his company, and he's going to net, I don't know, 11.5 million or something. And you can do this. So just to comment here, start the clock for the QSBS. The earlier the better. There's a form 15620 that you file, or you can write a letter. But again, really, really powerful strategy there. Yeah, thanks, Lana. That 83B election, that's that last bullet point there. So again, we don't mean to get too deep into the weeds here, everyone on the call on this, but we're happy to have conversations on this with you as well if you'd like.
Yeah,
and the law just got better, right? July, if QSBS was issued on or after July 5th, that second column there would argue that kind of made it better.
yeah. And I put a quote. Sorry,
Um, yeah, we'll go to questions shortly here as we get through the slides at the end here. So Elena, on female and diverse founders, this is something Elena and I were sort of talking about, and you got a bunch of them, a bunch of you on the call here, which is absolutely fabulous. Elena, do you want to talk to this slide?
Yeah, thank you, Jason. Yeah, there's a lot of unique considerations to think about, and we just wanted to touch on a few of them here, specifically for female and diverse founders. And UBS actually published a research report recently that I pulled some unique stats from. That the report was focused on gender lens investing and capital access. So I'll touch on a few of those points here. But first, when you think about exits for female and diverse founders, it's really important to plan intentionally. the report found that only 1.3% of US and European venture capital funding goes to companies founded entirely by women. So it is really important, and the planning really matters, and starting early on that. Second, it's crucial, as you guys all know, to build your networks and mentors early. But specifically for women, women only hold 15% of decision-making roles at U.S. venture capital funds, and just 23% of venture funds have a female partner. So access still, kind of runs through a small group of decision makers, which makes those intentional networking and mentors even more critical. Next, when access to capital can be tight, every term counts. So dilution control, liquidity, all of it adds up. Negotiating can be and is really important. And then lastly, seek out those gender lens investors who support those equitable outcomes. It really does matter who's on the other side of the table, and people invest through their own experiences, as you guys know yourselves. So female VC founders and partners were found to be up to 2 times more likely to invest in female-founded companies than their male counterparts.
Yeah, Elena, this reminds me, we've got a client, it's a sports agent, soccer guy, and he's got a couple of guys in the Premier League. He's got, I don't know how many players in MLS and in the USL and tier 1, tier 2 teams around the world. And then he's got a bunch of women, 5 women on the US women's national team. So if anyone's a fan, you'd know who these 5 athletes are. He was telling me he's now getting 5 times the number of requests for appearances of those athletes, of the women, than even his 2 guys in the Premier League. And he's saying that the calls coming in for sponsorships of those athletes and requests for public appearances and so on. It's he says it's nonstop, and we're seeing this in women's sports. We've got a couple of clients who are now getting into ownership of teams, PWHL, NWSL, WNBA, and it's a huge business, and it's getting bigger, and it's wonderful to see. And we've got some female owners and diverse owners in all those areas as well. So I love that it's becoming. It's just sort of it's becoming, I'll say more, I don't know if accepted is the right word, but more common. And, it's great to see things become or moving toward being a little bit more equitable. We got a long way to go, don't get us wrong, but the money is talking. And again, I've met some of you on this call who are incredible female and diverse founders. So there's money that wants to invest in you. It's out there, and you're probably getting approached by it. Anyway, sorry for the editorial. Aleda, next slide, please. Yeah, so the Zilliq personal financial plan. We advocate doing the planning before you have the liquidity, right? Whether that liquidity is a year out, 3 years out, 5 years out, these are the things to think about, right? And any good advisor at any firms can help you with this. It's what we do for our business owner clients, of course. You can see all the points here. These are the things to think about, right? Retirement and kids' education. Do you want to gift money away? What does your personal balance sheet look like? We talked about that wealth gap. How much you need to live post exit, so we've got some great planning software. Most firms do. What's the probability of success? What's the chance that you will not run out of money in your lifetime? After considering taxes and inflation and varying rates of return and market volatility and so on. What are the saving strategies? What are some things you can do now to lessen the tax burden currently and later. The QSBS is certainly a strategy, but saving strategy, do you save to a qualified plan? Set that up for the business. You get a business deduction for that and a personal deduction for that, and so on. So, what several of you, I'm highly confident, are going to have some really big exits on this call. Well, what are you going to do with that surplus capital? If you're not careful, you could have an estate tax. In New York State, there's a cliff, right? So you can pretty much hit the top New York State estate tax of 16%, and then it's retroactive to $1, right? Skipping the table on that. There are ways to avoid that with some fairly simple trust and estate planning, and if there's still an estate tax bill, insurance might pay it. It's a really effective way to sort of take care of that, right? So these are things to be thinking about. I'll say currently, and work with your advisor on that planning front. Elena, next slide, please. And we're on the home stretch here. Here's the point of this slide. Money for now, money for later, money for others, for your own net personal capital, right? So that's the way that we think you ought to be thinking about your own proceeds from sale, right? Well, what do I need for now? The next 3 years of spending. What do I need for later? Those points on the previous slide: retirement, healthcare, a second home, kids' education, grandkids' education, and then so liquidity and longevity. Think core capital needs. Like, what do I need now? What do I need in the future? The way you're invested for those things is different, right? Liquidity strategies are different than longevity strategies. And then legacy. Well, oh, gee, there's surplus capital. You do your planning with your advisor and you see there's all this money left over at the end of the plan. What do you do with that? And the answer is, well, maybe you make a difference with it, right? Maybe you've got some charitable inclinations. Maybe you set up trusts and you also get to lower your tax burden on the estate level and maybe even on the income level while you're doing some good, right? So just this is a framework to think about your own personal money, liquidity, longevity, legacy. Elena, next slide, please. So roadmap this, right? Have someone you're working with. This is what we do for our business owner clients, and there are a handful of advisors who we think kind of do the same thing out there, regardless of the firm. So what should you be doing? Execute on the advanced planning, get those trusts in place, take care of the QSBS. Think about what you want to do charitably. These things need to be defined and executed generally in advance of any exit, in advance of a letter of intent that you receive, can be really meaningful as well. We talked about working with an investment banker to run a competitive process and bounce things off of in the meantime. And what does that next chapter look like, right? What is success? Is there a number? Is it, it's a lifestyle? We've had a couple of clients sell businesses who said, look, we really want to fly privately, which anyone who's flown lately can probably understand. We're like, yeah, this is why private aviation was invented, times like these. But that was important to them. There was a really high priority, so we planned for it and think about that, right? And kind of solve for it. They needed that client needed to compromise some other items in order to accomplish the private aviation objective, right? So you figure it out. Get that house in order. Personal finances, business finances, right? I know there are great tools that you've got on the launch site. I've sent links to a lot of entrepreneurs from the launch site, like, hey, this is what your P&L should look like. This is what your income statement should look like. Here's a template for a balance sheet. Do these things. Have basic estate planning in place. At least get wills done. You've got assets. You've got a company. You've got assets. If you've got dependents, and you don't have trust and estate documents in place, you're taking a huge risk, right? Like at least get a will done, and again, start that planning now. You might be able to get as much as $15 million of tax-free capital gains, but you gotta get that in place years before you exit. Think about it that way. Plan those liquidity events, the secondaries that we talked about, a partial exit, right? You might have heard the term equity recap and equity recapitalization. Sell off part of the company, right? To a strategic partner that you want to make sure you get along with, and map it out, right? How much you take off the table along the way, if anything. Map that out. Expand the team, right? Whether it's a wealth advisor with a financial services firm, it's it's a consultant, it's tax advisor, a corporate attorney. Have these people there. Work with them all. And again, there are a bunch of entrepreneurs and residents, a bunch of mentors on the call here who are just phenomenal. That's a real privilege that you've got these resources at your fingertips. Elena, next slide, please. So yeah, look, we've talked about this, right? Time, social life, purpose. It's more than just your balance sheet. Sorry if that sounds hokey, but it really is, right? Where are you going to spend that time? Your social life's going to change when you sell your business. So yeah, think that through. That's important, right? That's how do you quantify that? I don't know, but your social life will change when you sell. We always see that. And what's your new why, right? And I said this at the beginning of the call. Part of why I intentionally decided to focus on working with business owner clients was because I felt like, man, if Launch New York was there when I was doing it, we would have exited, so much more optimally, right? And the ecosystem, the entrepreneurial ecosystem here in the late 90s was pretty nascent. It's amazing now. Like, this is a fantastic place to be now. Sorry if I sound like a homie, but I feel that way. And that being said, what is your why? Like, what's the new why? It's been your business, right? And you probably started that business because you were passionate about this thing that you created. Great. When you sell it, then what? Right? Have a why. I got into the wealth management business. It took me a long time to realize why. Originally, I got into the wealth. I'm 59 years old and been doing this since the day after undergrad. So, for the first 10 years, I'm like, oh well, I do this because it's the second most exciting thing I could find to do with my life, other than stopping pucks for a living, which I really wasn't good enough to get paid to do, right? So, talk about entrepreneurial interests going awry with hockey passion, and doing a pro roller hockey team. And by the way, we lost a lot of money on that, although tax wise it was very beneficial. But the point was that, well, I thought I was getting into this business because it was exciting, right? Every day was different. It still is, and that's true. I get up every day and like, every day is exciting. I'm like the golden retriever every day. Like, this is a great new day. And and then I realized later it was, well, no, it was more about my upbringing. I grew up in a financially illiterate household with artists. My dad had a band on Capitol Records in the late 60s. My mother was one of the world's foremost pattern designer. My godmother was a really big rock star, still is to this day. Had a bunch of #1 hits when I was a kid and went bankrupt twice. And then hockey gets me out. My grandparents paid for me to play, and I'm staying with billet families, and all of a sudden I'm around wealth, and I'm like, how do they have wealth, right? And I realized, wait, it's just financial literacy, and we can help people. So it's part of what I love about what Launch New York is doing. You're helping people. You're helping. Launch is helping you guys who are on this call be successful. You're on this call because you care. You're taking advantage of it. So, what is your why for your business, and your life? Keep that in mind, right? It's a mindset. Elena, you mentioned it earlier, like, networking and being around others in your space, and mentors and so on. Do that and keep that, and do your planning along the way as well. Next slide, Elena. And we'll finish up here, right? So start now, engage those advisors, build that personal plan along with your business plan. Personal plan, business plan, you guys all know it. They're works in process. Inherently, the best plans are works in process, right? Because life evolves, businesses evolve. AI, right, kind of has evolved as we move from enablers to application layer business with AI. Like, talk about evolution. Like, all of our businesses are changing. So keep updating that plan. You've got a network. You're in it right now, right? Use it, use them, talk with them. Like, we all want to help. Next slide there, Elaine. Yeah, so again, we'll send this out. Our contact info is here. There's a cheap plug here for our UBS Business Owner Resources, ubs.com, ready to sell. So we really do have some terrific business owner resources. It's pretty differentiated, I think. So we're here for you. We'll jump to questions. And I'll tee up the questions by just noting a couple of statistics here. We just did I don't know, Elena, if you can flash it on the screen, just the title page of the Global Entrepreneur Report. I've got it in my hands here as well, but we'll send this out. But I'll just put a few stats here. And UBS surveyed 214 entrepreneurs globally, and there were three conclusions. One, optimism is really high. Two, many founders win on enterprise value. Three, despite the headlines, it's not IPOs that comprise most of the exits. It's strategic buyers, and that has some major implications for planning and timing and taxes. We talked about some of those. Yeah, this is the report here. So 40% of those surveyed said they plan to sell to a strategic buyer in the same industry. 23% plan to transfer the business to the next generation, right? Family. Sometimes it's employees. Only 13% expect to sell to private equity. I was really surprised that number was that low. Only 6% are considering an IPO. I would say of the, 100 business owners we have as clients, Elena, I would say 2 of those are intentionally pursuing IPOs. It's less than 6 with us. Optimism is really high right now. 68% of entrepreneurs are optimistic about their business outlook, right? In their business, their industry. Then over the next year, a third of them are thinking about exiting their business within 5 years. For entrepreneurs age 65 and older, that number goes a lot higher. It's like 57% considering a business transition in the next 5 years. Enterprise value, I mentioned this last comment. They're great in focusing on enterprise value and accelerating value, right? And you guys are doing that, and we see this all the time. What they've done though is they've delayed their personal balance sheet planning until the exit's already in motion. That ends up costing them money at the end, right? So I know we're all super busy how do you make the time to do that personal planning? It's really important. It's going to net you more money, and we can actually quantify that, right? And your advisors can help quantify that. So anyway, just some comments from the report. Again, we'll send this out. It's a long report. It's really fascinating. We have a QSBS piece too, a separate qualified small business stock white paper we'll send out. So with that, I would love to open it up for questions. Zach, how do you want to do the questions here?
Yeah, there were two questions in the chat. When does the QSBS holding period begin for convertible notes and safes?
Okay, so that 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 period, well, convertible notes and safe notes. I mean, you'd have to be on the stock front. So, if I mean, you want to be either 3 years or 5 years out. Elena, if you can bring that, I don't know if you can bring that slide up again, and happy to talk offline about that. But it's from it's from the issue of the it's from the issue of the note. I think I understand the context of the question is probably, well, wait a minute, it's not converted yet. It's that, right? So I say from the issue of the note, it's from the conversion date to the equity that would begin. And we can follow up. Zach, if you want to get us the whoever that was who asked that, and we'll get some more specific info to
Yep, absolutely. And then on this slide as well, I believe this is referring to the exclusion limit, but do gross assets include your valuation?
Yeah, like the 409A. Do gross assets include the valuation? Yes. I mean, the answer is yes to that question. But there's a way probably to get that number to be lower. So that's where my mind is going. So again, happy to follow up separately for more detail on that. I love that question. Love both these. Both those are wonderful questions.
Perfect. And then, in your experience, maybe a little bit higher level, is there anything that you're seeing that founders are consistently underestimating about the exit process?
Yeah. Yeah. Gosh, the answer is the personal planning, right? It's this. They underestimate the importance of the personal planning, like almost all the time, right? Like, that many founders win on enterprise value, but delay personal balance sheet planning until the exit's already a motion point, right? 32% of entrepreneurs in that survey said that they have not built up as much personal wealth outside the business as they could have. And then 56% of those say it's because they prioritize growing the business over personal wealth, right? We all get it, right? We're working on the business, right? It's you know, but that's always always more than half the time it's a regret, and certainly in the survey it's acknowledged as such. And and it's funny, the survey also said 42% plan to focus on building personal wealth after exiting or selling the business act. So yeah, you leave a lot on the table if you wait until afterwards. So again, look, that's incumbent on the advisors, on us as advisors as well, to stay in front of our business owner clients, right? The attorneys, the wealth advisors, the accountants. Like, hey, that's our job. Like, we're here to serve you, the founders, and get you to pay attention to that. Sometimes we feel like we're leading the horse to water, and the horse doesn't want to drink. But sometimes we got to IV the water, I think.
Okay. I got two more. We'll try and sneak them in, but we are up on time. But I think this is a really good one. As these founders are having these exit or acquisition conversations, what advice would you have for them to maintain leverage if an acquirer knows that they need capital or runway?
Yeah, yeah, that's a fabulous question. The short answer is to be knowledgeable about valuation and be knowledgeable about those, very specifically in your industry sector, your subsector, right? Do that valuation work. We've got valuation light tools that we can utilize for clients, and we do all the time. Other advisors do as well. Uh, Go in armed, right? No, hey, wait a minute. I know that my company that looks like this with these metrics, this quantification, I know companies like mine are selling at a multiple of whatever it is, EBITDA, CAGR, revenue. Like, come in armed to that conversation. Don't be defensive about it. Just be like, it's a matter of fact. By the way, here I have the piece, right? Here's my valuation. Like that. That is so helpful, and it's really simple. Like, it's really simple. Like, we arm our clients with those anyway. Like, hey, you got to have this. And if you're engaged with the boutique investment bank, right, to sell an investment bank to sell a company, they're gonna be doing that for you. But you want to have that partner there as well. Make the investment banker the bad guy.
Sure, that's never the general opinion about investment bankers. Uh, but I guess we are up on time. So any final closing remarks from your side?
No, just again, thank you. This has been an honor and a privilege to do this, and we're here to help. If anyone wants to reach out, we're delighted to talk, and again, we'll send the follow-up material.
Perfect. Jason, Elena, thank you so much for your time. And everyone else, thank you all for joining us today. And as noted, we will be providing additional resources from UBS along with the webinar recording. Thank you all.